Welcome to the daily update, where I'll go over the action in the market from Monday, February 24th, and we'll see how things look for Tuesday, February 25th. Okay, look like, yeah, we'll get a nice little bounce on Monday. Maybe they overdid it on Friday with options expiration. We closed at the low. The smart money seemed to take the day off. Well, it started out that way. The futures were looking fairly strong. We were up about 0.5% before the market opened, and we had maintained that level. So we weren't seeing a lot of gyration before the market opened. And we opened positive, and within about 10 minutes, we set the intraday high. We ended up going down. We went negative. We hit some support, tried to bounce up off of that, but that didn't last. We actually went back positive there for a little while and then went back down again and closed at the low. So, yeah, we're seeing things turning more negative. We're now negative not only in the short term, that happened after Friday, but we're negative in the intermediate term because now we're below the 50-day moving average. We're still positive in the long term. And we're seeing this shift away from growth over into more defensive areas like value. And I'll show you some of the charts that go through that and show how we're seeing things deteriorating. Also, the second half of February, which we're right smack in the middle of, actually getting closer to the end. Um, this tends to be a weak seasonal time. And you've got a lot of concerns about all the changes with Doge and executive orders and geopolitical things going on, and the market's just kind of taking a bit of a breather right now. Okay, so right at the open, we did have a higher open. It looked like, all right, maybe we'll just see some kind of a bounce. Now, this could be some carryover from Friday that there was a lot of movement in Friday's session to the downside, and that meant a lot of options got exercised or options that were actually showing a profit or showing some worth suddenly were not. And then in Monday's session, it could be okay, now we have to figure these things out and square them all up. And some people refer to that as max pain. There's been some studies on that. There's some ideas behind that. And a lot of times that can carry over into the next week. We'll see if it carries over into Tuesday. But in the meantime, we are turning more negative where other areas of the market are seeing some strength. So we did see a higher open, and then we hit resistance right below the daily pivot at 6,046. That was the intraday high. Then we declined. We went below the unchanged level to go negative. We got almost down to S1 at 59.76. So we're below the 6,000 level. Then there was an attempted rebound, and we actually went positive after that. But then we just stalled out. It just kind of fizzled out. Didn't seem to really go anywhere as we got later in the day. And then we started to decline. We got back down below the unchanged level again. So we went negative. And this is where the smart money came in and said, okay, we're going to do some selling. And we did see some late day selling. And then we closed back down almost to S1. So it was kind of like a big N, a big boing from a kangaroo or something. We were down just 0.5%. So on a percentage basis, it wasn't that much, but you see the interplay of what was happening inside the day. And I'll show you the chart. Yeah, there was a tug of war going on with the sellers winning, and we were above average with volume. And as I said, we are now negative in the short and intermediate term because we're below the 20 period moving average and the 50. Now, interest rates are actually kind of behaving right now. This is seen as more of a flight to quality as the market has been getting more defensive. They're getting out of stocks and going over into bonds. And when people buy bonds, prices go up and interest rates go down. We're going to get another inflation reading later in the week. In fact, on Friday, with the PCE report that comes out, that has the core PCE, and that's the Fed's preferred inflation gauge. But that will be coming up on Friday. And then the geopolitical things going on that could always escalate between Russia, Ukraine, with the US involved in that. And then there was an election over the weekend in Germany, and Germany seemed to like that, but the rest of Europe, at least they were down in Monday's session. And any one of these things can escalate at any given time and actually have an impact on the market. Okay, so some comments. President Trump did come out and say that those tariffs that were announced and then delayed, they're still looking to go forward with that after they had been delayed for a month. The S&P is below its 50-day moving average. That's a pretty big line in the sand. That's the line between positive and negative in the intermediate term. Some folks may use that more for the long term. I use it as an intermediate term gauge. And then Apple, they actually were the one little bright spot in Monday's session. They plan on investing $500 billion, dollars, my goodness, $500 billion domestically over the next 4 years. And there's also some speculation that the commitment could result in a tariff exemption for the company. Well, that's kind of what these tariffs are supposed to do, is if you invest in the US and you try to bring business to the US, that's why these tariffs are actually being implemented to try to bring everything home. So yeah, they may get an exemption for that. Now, one of our primary indicators, the parabolic SAR, it's now turned negative. And so we're looking more negative. There's one primary indicator that I'll show you later on that actually showed some improvement on Monday and is turning back more positive. We're still looking extreme. If you look at our stochastics chart, which I'll show you in just a moment, we have one part of the chart that's extreme negative. The other part is still extreme positive. And we're getting a little bit longer list now of those things that are showing negative momentum to the downside. Now, this is where we want to pay a little more attention. How I usually look at this is if we're in a longer term uptrend, which we are now, that hasn't changed, and we start to go up and become extreme positive, well, we can ride that for a while. In a very general sense, there are exceptions. An exception could be we're switching over to a more defensive stance with the market, is that when we start to become oversold or extreme negative, when the long-term trend is still positive, sometimes that doesn't last very long. We'll try to, just do our analysis and see, okay, are we switching more like we saw back at the end of 2021 going into 2022? And there's probably folks out there that are already declaring that. But we'll just watch things. We'll watch the evidence. We'll look at the charts and just see what seems to be developing. But as of right now, with the long-term trend still holding up, look at this as not necessarily lasting long until proven otherwise. With the Stochc RSI, the Williams percent R, CCI 14 and 20, then the short-term stochastic is already extreme negative, where the longer-term stochastic is still extreme positive. And the force index is looking extreme. No change to the scenario. We'll see if the core PCE report coming out later in the week will actually change anything there. And the dollar was up. That put pressure on stocks, and interest rates were down, which there's at least over the last couple of trading days, there seems to be a decoupling where stocks were really following interest rates. If interest rates were going down, stocks were going up, and vice versa. Now interest rates are continuing to go down as more of a flight to safety kind of a thing, while stocks seem to be a bit under pressure right now. We're at 4.39%, where we had been at 4.42% after Friday. And sentiment is now negative. We were drifting around last week around the neutral area. And then after Friday, we dropped down to the high end of the negative range. And now we're getting more to the lower end of the negative range. So we were at 35 on Friday. We're at 29 right now. And we are, at least based on what we see right now, starting a new trend, and that trend is negative. So the ADX is starting to get stronger. It's turning up and crossing above its moving average. It's still below 20, but when it crosses above the moving average, that means a trend is starting to get stronger. It won't officially be a trend until we cross back above 20. With the down day, our bias is negative and our momentum is now negative. Where bias is just we had a down day and things were pretty negative. Momentum is the last 2, 3, 4, 5 days kind of taken together. All right, so we didn't have any economic reports in Monday's session. We'll get a few in Tuesday's session here. And then it says the bull market might be 2 years old because we bottomed in October of 2022, but it is still young. And so we don't know. We've seen some pretty significant declines even since October 2022, but we've been able to recover from those. That's what we're trying to evaluate right now. Is this just a pullback? Is this just normal? And typical weak seasonality that we see going through the latter part of February, or are things really shifting and turning more defensive here? But usually the average is 5.5 years, with the median being 5 years. Well, we're just starting into the third year because we're 2 years old now, going into the third. So bull markets like this can go on for quite a while. That's why I'm not a perma bear, because if you look at the long-term chart going back to, let's say, 1900, yeah, there's some pretty severe downtimes that really do a lot of damage. But for the most part, you see a straight up chart 70% of the time with some major dips along the way. Okay, then margin. This is, there was a chart last week that I talked about this. This is when you borrow money to buy stocks. And it's getting kind of high now, where folks are saying, well, yeah, the market's just going to go up. We can go ahead and start to borrow the money. Well, it's not a 50-50 partnership with your broker. If you borrow $10,000 to buy stock and now your stock's worth $2,000, you still have to pay that $10,000 back. It's not like you're splitting the difference with the other side here. And that can really avalanche things to the downside. You have what's called a margin call. Well, this is the margin debt year over year, and it's going up because folks were getting more confident about the market itself. And then short interest. Now, this is still a pretty low reading at 2% right now. You can see other times when it's a lot higher. There could be some explanations for this. Personally, I do play the downside of the market when we're looking negative, but I don't go in and short the market the way a traditional short seller would do it, because the risks are virtually unlimited and you have to have really high margin requirements. What I do is I take advantage of put options if I'm playing options, or there are inverse ETFs and mutual funds that go up in value if the S&P goes down. And those are a lot safer and the margin requirements are a lot less. And it's just like, okay, you when you short the market, you're opening yourself up to unlimited risk. Where when you do it the other way with put options, that's all you could lose. Now that's pretty bad, but that's the maximum. Or with your ETFs that you do, you could lose more than that, but still it's a much safer way to play the downside. And so that might be in play here as to why we're seeing, even though it's been going up here, it's still a really low reading overall. So, but then on the positive side, we watch this because we want there to be kind of a high percentage, because if the market really does go up, like I said, 70% of the time it does, and you see the market going up and up and up and it's out of control, well, that's called a short squeeze or a short cover rally. All the people that are shorting the market, they're having to get out. Well, when they set up their short position, they have to sell to get in. I know that sounds strange to some of you, and then you have to buy to get out. And if the market's going against them, you see all these short sellers having to buy, and that just makes prices continue to shoot higher. All right, then weekly announced buybacks are seeing a bit of an increase here. If we start to run into more difficult times with the market, we'll see if we still see an increase in the buybacks, which is seen as a positive thing. The company comes in, they're buying back their own stock. It's like, oh, they have confidence in their own company. We're going to buy that company too. And it also makes fewer shares available on the market, which makes them more precious. Okay, then call volumes have risen sharply relative to puts. Well, we'll see if this. Now, you could take this a couple of different ways. This has been positive in the past, and we saw this close to the end of the pandemic equity boom in late 2021. Well, that's when we started to fall apart here. Okay. And if a lot of people are buying calls, which go up in value if the market goes up, and we're seeing that and in some other charts beyond just this one, well, the market will quite often do the opposite of what a lot of people think is going to happen. And sector fund flows, still, most of the money's going into tech, even though it has been dropping down lately. I didn't really spend any time on Twitter or X over the weekend and in Monday's session here, but here's the intraday chart. This is Friday's move down that just didn't see anything but downward movement. And this S3 right here, that's right about at the 50 period moving average for the S&P. Well, it looked like, okay, maybe we'll be able to bounce up off of that. And it's probably hard to see here, but we did almost get up to the pivot point, but that didn't last very long. That set the high for the day and then immediately started coming down, went negative, dropped below the 50-day moving average, came down almost to S1, and then it looked like, okay, maybe we're building a base to move up out of. And for a while, it looked like, okay, but maybe it was a little too early in the day. The smart money comes in later. And this is just, okay, buy the dip, which is something I do not implement, but a lot of people do. And that's what folks here were trying to do. And they thought, oh, what a genius I am. We're going back positive. But then things just stalled out. And then the smart money comes in and they start doing their selling. And then we ended up closing right at the low, pretty much at the previous low that was set earlier in the day. So all these genius folks are like, oh my gosh, I was seeing a profit. Now all of a sudden I'm seeing a loss. And that's one reason I don't buy the dip, because that's very frustrating to get into a position and immediately have it go against you. And so I just find that really disheartening from an emotional standpoint. First of all, I hedge everything. So if something like that does happen, I can just say, okay, didn't work out there. But to get into something and then start seeing a profit and then have it turn into a loss, yeah, that's another thing I do is if I'm seeing a profit and we go back to the break even point, I get out of those positions too. It's just something that I've developed over the years. But now a lot of these folks, the emotions that you go through who started to buy right in here, and now it's like, oh my gosh, what are we doing? Okay, and then we're up a little bit in the initial overnight session here. And you can see that the futures, when they started trading Sunday afternoon and evening, we were up about 0.5%. We were back up over the 6,000 level. It looked like, okay, maybe we're going to get a nice little bounce here. But right when the market opened, boom, we went down, tried to recover, and then closed at the low. Now, this is starting to turn negative too. I've been talking about the blue line being above the red line. That's more positive. That's the intraday chart of large cap growth versus value. Now we're seeing the blue line dropping below the red line. Now they are on different scales, but we can get some relative uh, action here to see how they're performing compared to each other. Where now, since this is going down, that's turning, at least on an intraday basis, the growth to value ratio more negative. And we're also coming back down here. We're not quite back down to the low that we set at the end of January. This was looking pretty good here. And then we flattened out a little bit. But now, since about the middle of February here, we've been seeing this really coming down now. So this is showing some weakness as well. On an end of day basis, value ended up being positive, where growth was down over 1%, and it was down more with the mid caps and down less for the small caps. So the small caps are having their own little problems. They're negative no matter how you look at it these days. So looking at the small caps here, we are seeing more of a deterioration on the end of day chart with small cap growth to value. It's still in an uptrend, and it was looking pretty strong and then leveling out. Now we're seeing some weakness. What we're trying to figure out now is, are we going to continue to go down with this, or is this uptrend going to be able to stay intact and eventually we'll bottom at some point and then start to bounce up? We were getting right close to the 200-day moving average after Friday. Well, that didn't provide any support here. We ended up just falling down even further below it. And we're seeing kind of that same thing with the mid cap growth of values too. This is in an uptrend and it was looking pretty good, even though the indexes are not doing all that much. But now we're seeing growth really taking a hit here. And we were at the 50 period. I think it's just a little bit below the 50 period moving average after Friday. Now, could we be coming down to the 200-day moving average? Now, remember the mid caps, because if we do get down here, that may provide a level of support, which means there's going to be more weakness if that happens. But when we get to the mid cap chart, it's at a support level. And back in 2024, especially in early 2024, that's where some support came from. It wasn't from the S&P, it wasn't from the Nasdaq or Nasdaq 100. We hit a low and a support level with the mid caps, and then we're able to bounce up off of that. And then that brought the rest of the market back up with it. Now, I don't know if that's going to happen this time or not. That's why we look at all different kinds of charts to say, okay, keep that in the back of your mind, and we'll just see if that's something that's going to happen. And I'll point it out again when we get to that chart. And we are seeing a more weakness here with S&P growth of value on an end of day basis, but we're still in an uptrend here. And this is also showing some weakness, a growth ETF versus a value ETF. And then we do a ratio between the two, coming back down into about the middle part of the rainbow. Now, this is where we're seeing a big change, and this is causing some concern. You can see discretionary, yeah, it got hit, and we're below its 50-day moving average when we look at the equal weight discretionary ETF. But look at the big surge that we're seeing right now with the staples equal weight. That's why this ratio is really going down. But notice we're hitting the 200-day moving average here, and we haven't gone above that at least yet. That's another thing that we will be watching. Are we going to get above this 200-day moving average with just the staples by themselves? This could hit this and turn and start to come back down, which might start to help to improve the discretionary to staples ratio. So just another thing to be watching here. Large cap growth, it was holding up, looking pretty solid, even though it was going sideways for most of 2025. Now we're coming down to the 100-day moving average. Is this a possible support level? Could we bounce up off of that? This is the first time since, well, back in 2024, we broke below it. But this is we're going a little bit deeper than what we were going so far in 2025 and through most of 2024. Could we get some support at this level with large cap growth? Now, looking at the trend, we're starting to turn up with ADX and going above the moving average. So that's why I say we're starting a new trend. We're not officially in a trend until we go back above 20, but the red line is going up, the green line is going down. So that's why this is a negative trend that could be just starting. And here's the short-term chart, also turning up, a little bit more aggressive because it moves faster. It's a short-term chart. Also negative, above the moving average with the red line on top and the green line going down. Volume is above average, so it's been pretty healthy that way lately. And then here's the weekly chart of sentiment where it still has us up in the greed area. The chart that we look at is way over here in the fear, which I call negative area. And we're back down in here. This is the legal insiders to like CEOs and corporate officers. This is actually turning a little bit more bullish right now. And then when I have that chart, I also show this. This is the insider buying ETF. And it's been just going sideways pretty much since the earlier part of 2024 for about a year now. So there hasn't been really any advantage to owning this ETF, even though it's still in an uptrend. And the VIX did go up, but we're still below 20. So we're going up on a closing basis with the VIX. We got close to 20 there on the bar chart, but we ended up closing down below 20. When it goes above 20, that's when we see negative annualized returns. They remain positive when we stay below 20 with the VIX. Also picking up with the VIX of the VIX, above the moving average, and that's the bar chart, and with the line chart, which is the closing value. That really is picking up as well. The momentum for the VIX, we saw this after Friday. It started to switch to up, and it's continuing to go up now. Still getting a really high reading. This is part of the possibility of the chart that we saw earlier about a lot of calls being bought. And they may be why the skew index, which is a variation of the VIX, but it's calculated using out of the money options. No matter what seems to happen over the last couple of months, we still get a very high reading here. Now, I have tried to conclude that these are people that are buying a lot of call options. I could be wrong about that. I've tried to interpret this chart as it's been jockeying around in this red area with no real definitive conclusion. I just know that we keep going up into this red area and staying here without it coming down. Then I do go over this over the weekend with the individual investors. This is the bull bear spread where they did tick up in the latest reading, but we're still below zero. So they're negative overall. The chart that I show, I also plot a 50 period moving average on here, and it's starting to turn over as well as individual investors are becoming more pessimistic and negative. This is also a chart I usually show over the weekend. It's a sentiment indicator here. It still has us as positive. We're below the dashed line though, so sentiment has really been coming down lately. And we're seeing a bit of a mix here where we declined with this fear gauge because bonds are seeing some love right now. But you look at this other fear gauge here and we're going up. So that's a bit of a contradiction. And we're keeping an eye on the risk on to risk off ratio. It's been really choppy over the last, well, since the beginning of 2025. We're starting to go down with this now as folks are tending to get more defensive. They're going to risk off because there are money managers out there that have to stay invested 100% of the time. They can't go into cash like we can. And so what they do when the market gets more defensive, they get into stocks that have a tendency to go down less and possibly even go up because they have to be invested at all times. And when that happens, that's when we see this ratio coming down. Now, we've been really choppy here. We'll see if this really starts to fall, that will show some more follow through conviction. If we get a bounce, we might see this ratio begin to come back up a little bit. And then the daily chart of the equity put call ratio actually went down, but we're going back up with the 5-day chart and also the 10-day chart. And that's more negative. That means that there's more puts being purchased than calls, so the market is becoming more defensive. And we're getting up out of the range here with the volatility risk premium. It's starting to pick up an increase in fear as well. But our advanced decline line, excuse me, our advanced decline line is still positive. We're still above these advancing moving averages. But you can see we didn't really move all that much based on price. We're actually declining a little bit more based on volume. But so this is actually holding up. It's really the bigger stocks, the large caps, the mega caps. Those are the ones that are getting hit right now, where folks are seeing some rotation possibly into the rest of the S&P, which are more defensive. And that's why we're seeing this holding up fairly well. And we actually advanced here with their advanced decliners with the 10-day average. This went up and went back above zero, where after Friday it had dropped below zero. So that just means there's some strength coming in to the rest of the S&P 500. And then the new highs, new lows. With that move up that we saw right at the open, we saw some new highs being generated and not very many new lows. So this is also suggesting there's some under the surface strength still staying there. What we're worried about is this strength is going into value instead of growth. It's going in more into defensive types of stocks rather than offensive stocks, the stocks that you want to buy low and sell high. That's what we're trying to figure out here. So we're still kind of going up here with the 5-day average, and we're flattening out and declining just a little bit with the 10-day moving average of the highs, lows. And we're still above zero with our short and intermediate term advanced decline ratio. So this also suggests there's some areas of strength inside of the S&P. And we're coming down with smart money indicator number one. It had been really far away from the moving average, and so it's pulling back. Now, this is still positive because it's above the moving average, but clearly the context over the last 2 days has been down, and so you might treat that as a little more negative. Our other smart money indicator number two, it's declining now. We're seeing the histogram falling off. We're seeing the red line going down. So that one is negative, and we're really declining here with the Chaikin oscillator. It declined after Friday and actually turned negative. It's even more negative now. But this is interesting. The vortex, which turned negative after Friday because the red line was just barely above the green line went up and the red line went down slightly. So this is actually switched back more positive. This indicator is picking up something positive that it's seeing in the S&P 500. And not much of a change though with the advanced decline line for the S&P based on price, just kind of chopping along sideways, seeing a little bit more weakness here based on volume. And then looking at the broader market, the NYSE cumulative advanced decline line, it is declining, but we're not really showing that big of a change. We're declining, but we're still above the moving average with the regular advanced decline line. And also seeing that same thing. This is another advanced decline line that's calculated in a slightly different way. We're chopping along sideways above the 50 period moving average. When we break it out based on common stock with price, yeah, we're seeing some weakness here. And we're also seeing a bit of weakness when we look at volume. But when you look at the advanced decline line for the S&P, we're still above the moving average and it actually went up. Where we're starting to drop down a little bit with the NYSE common stock, the mid caps, the small caps are just not doing really well these days. And I don't show this chart all the time. This is a broad market measure of the 5 period moving average of the highs minus the lows. We're starting to drop below zero. So that's turning, and that's a little more broad market negative. And those stocks above their 20 period moving average in the S&P ticked up. Still negative because we're below 50, but it actually bounced up a little bit. So there is some strength coming into the rest of the S&P 500. We ticked up with the 50-day moving average and it's still above 50. So that's helping the intermediate term to stay positive. This chart won't turn negative unless we drop below 50, where we're below 50 with the 100 period moving average study and we were flat. And we ticked up a little bit with the 200 period moving average study, and we're still well above 50. We're in the 60 range now. And then we're looking at large cap to small cap with a ratio. This is continuing to go up. And it's not that large caps are doing good, it's that small caps are just getting hammered. All right, here's a daily chart. And as I've been pointing out lately, it's hard to see this because the pivot points are now coming in here for February. That's what I like about pivot points. They're there. Sorry, for March, for the new month coming up. This is why I like pivot points. They're on the chart before we even get there. And so this is something that we can know ahead of time and go, oh, isn't that interesting? We're hitting resistance. Oh, we're hitting support. And then at the bottom, we were above average with volume. We actually ticked up a little bit with the 20 period moving average. We were flat with the 50 period moving average and flat with the 200 period moving average. And now this is part of the negative momentum that we're seeing. The Stochk RSI for 2 days now has been extreme negative. A new addition to the list is the Williams Percent R, CCI 14, and the CCI 20. These are the ones that we want to be careful because the bigger picture is that we're still positive. So we don't know how long we're going to stay in this type of a condition. And here we are already extreme negative with the short-term stochastic. This is a further subdivision of the short-term time frame. We're just dropping below the midpoint with the intermediate short term, but we're still extreme positive, but crossing below the moving average with the long short-term stochastic. So yeah, you can be extreme positive and negative here on the same chart. We're getting extreme with the force index. We're hitting, this is a Keltner band, which is very close to a Bollinger band. They're very similar to each other. We're hitting this down here. So that's extreme, negative. And now we're seeing a further deterioration of the short-term trend based on 20 periods. Over the weekend, I was pointing out that the lines hadn't really started to roll over yet. Well, now they're beginning to do that. And this is a double and a triple exponential moving average. So this is showing further weakness short term. And we're dropping further below the 20 period simple and exponential moving averages. That's what turned us negative in the short term on Friday. And we're going into the -2 channel with our standard deviations chart. Intermediate term coming down with the balance of power after giving us an extreme positive reading. And we're turning negative with the go, no go with these brown bars. And we're dropping below the midpoint with our highest high value. We're now headed towards the lowest low value part of the chart. And I don't show this all that often because there hasn't been much to show. These are anchored moving averages, which are different from regular moving averages, where the way I explain it is if you have a 10 period moving average, you use the last 10 periods and then take an average of that, and that's your result. Where anchored moving averages try to project forward. And I have this drawn from a low that was set about a year ago, and we're coming right down to that level right now. Now, if we continue to fall, yeah, that could be more negative. I might even add another anchored moving average in here from this higher low, but that's the negative part. The positive part is this may act as support, and the other positive part is all these lines underneath it are still continuing to go up. And then we're looking more negative here with the TTM squeeze. We have the darker blue and it's going down. We actually ticked up with the ease of movement, but we're still below zero. And we really dropped off with the Arun indicator. This tries to measure the difference between buyers in green and sellers in red. We're seeing a drop off in the buyers, an increase in the sellers, and the oscillator down below measures the difference between them. And that's why we're seeing this going down. Now, it's still positive since it's above zero, but it is declining. And we ticked up a little bit with the S&P McClellan oscillator, but we're still below zero. So that makes the summation index going down based on price, and we're actually showing a little bit more enthusiasm based on volume. And I like to point out from time to time, the top part of this chart and the bottom part, these are two completely different indicators. I just plot them together on this chart. And but when we look at the NYSE, we're seeing a continuation of the weakness with the the NYSE McClellan oscillator below zero and continuing to decline. So we're starting to turn down with the summation index based on price and volume after we had been chopping sideways with volume. The swollen trading oscillator is still looking negative. We're declining based on price and volume. Momentum is now shifting negative. The PMO is crossing below its moving average. We're starting to cross below the moving average based on price. We're still positive based on volume, but rolling over now. And we saw a little bit of a tick up, but we're just about at the midpoint with the PMOs that are rising because that's inside. These are the PMOs, all the PMOs for all 503 stocks in the S&P, showing a little bit of internal strength there. But the buy signals are declining, and we're still flat with the PMOs that are above zero. And we're negative with the Elder's Impulse system. And this is a longer term moving average here. Maybe this will provide support. Other times we hit this and it didn't really seem to matter, but we're right at that point right now. And we've now turned negative with the parabolic SAR. There was enough of a decline on Monday to put the dot on top where we had been positive. So this is another primary indicator that has now turned negative. And we're starting to roll back over and turn negative with the slope oscillator. The MACD has already turned negative, dropping below its moving average. So in the short term, I have two oscillators here. They're now going down. The three intermediate term oscillators are negative, and we're starting to roll over and turn negative with our longer term oscillators. And the Copic curve, another momentum oscillator, is now back to declining. This is the condition of the intermediate term trend. We're rolling over a little bit with the blue line and the red line, but we're below these lines. The longer we stay below them, the more these lines are going to roll over and come down. And that's suggesting that the intermediate term trend is now vulnerable based on this chart, where we're already negative based on this chart. This is the 50 period simple and exponential moving averages, and we closed below that. It held on Friday, and it's held before even going back over the last month or so, but it didn't hold this time. So when we break the 50 period moving average, now we start keeping an eye on the 100 period moving average. This did provide some support earlier on in January where we came down. We never did close below it. We went below it, but we closed above it and then bounced up out of that. Are we going to come down and test the 100 period moving average again this time? And another point of note here for the S&P, we're right at this pivot point level, which could be providing support. It's going to be more negative if we drop down below this pivot point. So all of our moving averages here, below the 20 and 50s now, so the 100s come into focus. And we're back to declining here, but more neutral when we look at the Sean trend meter. We're still above 50 with the money flow. We're declining, but above 50 with the ultimate oscillator. Declining, but above the moving average with on-balance volume. But we're turning more negative with the RSI 14 and the RSI 9. And we're declining with the bullish percent index for the S&P. We're still above 50, but we are clearly going down. We're also dropping below 50 with the NYSE bullish percent index, declining but still above 50 with the NASDAQ 100 bullish percent index. And we're below this little mini rainbow, which is a 20 period simple moving average of the open, high, low, close. The longer we stay below this, the more these lines are going to roll over and start to come down. And this, in my opinion, is what's causing some problems. This is a long-term trend channel going back to 2009. We just cannot seem to get above this for any length of time. So this could be producing some problems. Maybe we'll have a little bit of a decline here, let this line go up. And so if we do make a run back up to the upside, at least the numbers will be higher than where we're at now. Just pure speculation on my part. Okay, we are now negative with the Heikin Ashi. We have the black candles. We're turning negative now with the Kegi chart. It's red and pointing down, but the Renko chart is still positive, but the three-line break chart is now negative as well. So we have three out of the four of our chart variations that we use to measure trend are negative. And I didn't show the long-term chart. We're still dealing with what's going on in the short and intermediate term. So we are negative in the short term across all the indexes. We're still negative in the intermediate term with the mid caps and small caps. And bonds have now switched over to being positive in the intermediate term after switching to positive after Friday in the short term. And this is also causing some problems too. Commodities are positive across the board, and that's producing some inflationary concerns. And the dollar is still in a short-term downtrend. So if you look at the different sectors, you had healthcare, real estate, those are defensive. And they were the top performers. Now, financials, that's good. The banks are holding up pretty well. But then staples, that's another defensive area. Communication, this might have been having to do maybe Apple with the update there, but it ended up being barely positive. But this is a growth area, and it ended up being up. But if you look at tech and discretionary, these are other growth areas, and they were down. We did see utilities taking a bit of a hit. That's usually a defensive area. So there's not a real cut and dry picture that we can get from the sector action on Monday's session. And an awful lot of red here. We had the MACD crossover on the bear side for the NASDAQ. Then the NASDAQ, first it got above 19.6, then it was below 19.5, then 19.4, 19.3. And we got below 6,000 with the S&P. Tech had a bearish MACD crossover. And then discretionary. These are growth areas here. This is doing some damage with a BPI cross below 50. And we actually saw the equal weight version of the S&P tick up a little bit where the S&P weighted version was down. And so we're coming down a little bit here, but this has been really choppy lately too. And if we start to go back up, this is going to get choppy again. But if this continues to fall, that means the equal weight version is outperforming the weighted version of the S&P. And we're now seeing where the Dow, its 50-day moving average, at least in Monday's session, acted as overhead resistance. And that might have been where we stalled out with the S&P. We hit the 50-day moving average with the Dow and then started to come back down. And we're negative with the Elder's Impulse system for the diamonds. And the NASDAQ losing these pivot points here. There's the new ones coming into play soon for March. But we were down 1.21% here. And this is something that I was pointing out as positive. It's really hard to see, but because of the new pivot points. But the NASDAQ 100 was also down on Monday. But after, excuse me, gotta love these take one videos. We were still above the 50 period moving average after Friday. We lost that in Monday's session. And we're negative with the Elder's Impulse system for the QQQs, which is the NASDAQ 100. The momentum for the NASDAQ 100, which had been barely hanging on to being positive, has now switched to negative. And now we not only crossed below the 20 period moving average with the triple Qs, we're now below the 50 period moving average. I don't have a 100 period moving average on here. Now, just by looking at this and eyeballing it, you can see we have a low, and a low. This could be a trend line right here. Will we find some support coming up off of that? We'll have to see if that ends up playing out, and I'll keep an eye on that as well. We're further below the 200 period moving average with the S&P 600. That's one small cap index that I follow. But this was giving us some hope after Friday. We came right down to the 200-day moving average with the Russell 2000 small cap index. Now we're dropping below it. It held earlier on in January. We've now broken below that this time. And we're negative with the Elder's Impulse system for the small caps. This is what I wanted to point out with the mid caps here. We're right at the 200-day moving average. Will we get some support off of this? Okay, we don't know yet. We might see further weakness, but this virtually was unchanged. It was down 0.13%, but this level is still holding for the time being. But we're negative with the Elder's Impulse system for the mid caps. The Wilshire dropping further below its 50-day moving average. That's a broad market measure. We're also dropping below the 50-day moving average with the total US stock ETF. And this is going up, the staples to tech ratio. If the market's getting more defensive, we will see this continue to go up and eventually see a golden cross here. This is what we saw back in 2022. Now it hasn't happened yet, but it starts off this way, so we're going to be keeping an eye on this. If this goes up, that's negative. If this can come back down, maybe the market's turning back to looking more positive. And then the financial sector was up 0.43%. And we like that. And it's still above its 50-day moving average, but we're below the 50-day moving average with the FANG index. These are the really big stocks. And they got hit 1.95%. We're dropping further below this longer term trend line now. Now, we fell below this before, but we were able to overshoot that a little bit and then come back. So we'll see if something like that comes into play. Apple was up 0.63% above its 50-day moving average, probably the strongest of the mega caps, where Amazon was down, Microsoft was down, Google was down, Meta was down, Nvidia. They're going to be reporting earnings on Wednesday. I think it might be after the close on Wednesday. They were down 3% below their 50-day moving average. And Tesla, which seems to be the name of the game these days, it was down over 2%. Netflix was also down. I actually watched a couple of movies that weren't too bad. Why did they fall? That's supposed to be funny. They're down almost 1.5%. And then we're seeing a little drop off here as world stocks are actually holding up a little bit better right now. That's the black line that you see where the US stocks are seeing some pressure. But longer term, the correlation dropping down a little bit, but it's still pretty much flat. Oil's actually going, well, it's up a little bit here, but we're in the low 70s right now, where we had been more in the mid to even upper 70s there for a while. And the dollar is still in an uptrend, but it did bounce up a little bit, and it could be kind of a bounce after it had been declining recently. All right, then we're still going down here. We're under that 4.5% level with the 10-year yield. And at some point, if the 10-year yield continues to fall, the market's going to go, wait a minute, something good's going on here. Our interest rates are going down. Let's go buy stocks. We'll just have to see when that point comes. Just like when we hit 4.5% on the way up, the stock market went, wait a minute, interest rates are going up. We don't like that. We're going to start selling. And we're going up with the 10-year based on price. Now, this is weakness, and I pointed this out over the weekend, and it looks even worse after Monday. This is the home construction ETF, the 3 to 7 year bonds. This is not a good looking part of the market right now. And we're keeping an eye on the 10-year yield in Japan. If this red line going up caused a problem last summer, we're going to see if it's going to cause a problem this time if the red line continues to go up. All right, and then we're now turning more negative with our growth to value ratios. The Qs to S&P below the moving average, discretionary to the S&P already been below with the declining moving average, and we're seeing more weakness with large cap growth versus value. Below the moving average with the large caps, really big weakness here with the mid cap and small cap growth to value ratios. And we're going back up here with the staples, the S&P 500 ratio as well. All right, so what's our outlook? NVIDIA will report earnings on Wednesday, and I believe that's after the close. We are now negative in the short and intermediate term, and we are possibly beginning to trend. And we're going to get the FHFA Housing Price Index, the Case-Shiller Home Price Index, and Consumer Confidence in Tuesday's session. And then we're keeping an eye on all the geopolitical things in case they have an impact on the market. And then on Wednesday, not too much, new home sales. We'll get the second reading of GDP. Now, we've already had the first reading. And if the second reading is not much different than the first reading, that'll be a non-event. But if it's a lot different, that could be impactful. And we'll get our initial jobless claims. And then the biggest one will be the core PCE on Friday. And here's also another look at the economic calendar for the week. Seasonality, we're neutral to positive for February 25th for the Dow and S&P. We're also coming into the week after options expiration where it's almost a coin toss, down 49%, up 51%, where we're neutral to negative with the Nasdaq. So not much of an edge there from a seasonal perspective. But when we look at this chart, we this is often on the 25th, where even though the second half of February tends to be weak, we might get a little bit of a bounce if we stick to seasonal patterns here. But then the end of February then turns back to being more negative. And here's another look going back to 1950, showing how the second half of February is weak. This also shows how the second half of February is weak. And you can see here, this is the little bounce that we might be coming into. And this is also showing that the February is the weakest month after an election. This also shows that same thing. And then the warning signs are we're now negative with our smart money indicators. Now, the accumulation distribution is still positive, but it's coming down. And then both the 5 and 10-day equity put call ratios are going up. And our S&P and NYSE McClellan oscillators and summation indexes, as well as the Copic curve, those are all negative now. Parabolic SCR, that's a new addition to the chart here. The Swirling Trading Oscillator is negative. The bullish percent indexes are going down. That's negative. And the momentum oscillators are declining and back to turning negative again, where they were after last Thursday, they were starting to turn more positive. Nope, not after Friday and Monday. The ease of movement, it's still negative, but it did go up. And the momentum for the NASDAQ 100, another new addition to the warning sign chart here, that the momentum for the NASDAQ 100 is now negative. Positive signs, growth to value, discretionary to staples, we're kind of looking a little weak there. We're going to have to see some real buying coming into growth to repair this. The reason why they're still positive is because of the moving averages that I have on those one charts. They're still in uptrends. And the advanced decline line, especially for the S&P, we're still above the moving average, but we are showing some weakness in the other indexes. The vortex actually went up. It turned negative after Friday. Now it's back to positive after Monday. And the money flow and ultimate oscillator are both positive, even though they are declining. Financial sector was up, and that's encouraging. It's looking pretty strong there. So our conclusion, we're negative in the short and intermediate term with the new trend starting, but we're still positive in the long term. So that's where we're negative now. In the short and intermediate term, we're below the 50-period moving average, but we remain positive in the long term. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.